Welcome back to the deep dive. Today we're pulling back the curtain on something, well, everyone talks about, but maybe few truly grasp: real estate investment.
That's right.
You've sent us a fantastic stack of insights from a Harvard program on real estate, covering really everything from the fundamentals to cutting edge tech.
Yeah. This is quite comprehensive material.
Our mission today is to cut through some of that noise, extracting those vital nuggets of knowledge that give you a real shortcut to being properly informed.
Hmm.
We're going to unpack what makes real estate unique, demystify its, often misunderstood
There
cycles,
isn't understood often.
dive into the essential financial tools you absolutely need, and then look at strategies for building a portfolio and navigating, well, today's market.
And what's crucial here, I think, is recognizing that while real estate feels very tangible, maybe even emotional,
Oh, definitely.
this material gives you a structured, data-driven way to approach it. It's not just about the bricks and mortar. It's about understanding systems, cycles, and will help connect those core principles with the latest trends, looking into 2025, so you can see where the real opportunities might be.
That clarity is exactly what we need. So whether you're maybe eyeing your first property or looking to refine your current strategy, get ready for some serious insights. Let's dive in.
Let's do it.
Okay, let's kick things off with the absolute basics. Beyond just being, a physical thing you can touch,
Hmm.
what are some of the truly unique ways real estate can, well, make you money and maybe even protect your wealth against things like inflation?
It's a great question because it really does stand out. Yes, it's tangible, unlike a stock certificate, and it's in that alternative investment bucket.
Right, with private equity and things.
Exactly. But its advantages are pretty compelling. You're not just hoping for the price to go up. You can generate actual cash flow from rentals.
Consistent income.
Consistent income. You get that long-term appreciation potential, sure, but also that built-in inflation hedge.
Yeah.
As the cost of living rises, so do rents and property values generally.
Mhm.
So your investment kind of keeps pace naturally.
That sounds incredibly appealing, almost too good to be true sometimes. But where's the double-edged sword? What are the big risks, like over-leveraging or maybe misunderstanding those tax benefits?
That's a vital point. Leverage using borrowed money, it's incredibly powerful. It magnifies returns,
It's losses too, right?
but it magnifies losses just as easily if you're not careful. The pitfall is often borrowing too much without enough cash reserves or not fully grasping market swings.
Hmm.
And the tax benefits like mortgage interest deductions, depreciation, they're great, but they need meticulous record keeping. A good accountant is key,
Definitely need professional advice there.
for sure.
Yeah.
But one advantage people sometimes forget is control. As the owner, you have way more direct control than with, say, a stock. You can actively manage, renovate, add value.
Right, you can actually do things to improve its value.
Exactly. Implement value-add strategies directly.
And that control, it probably looks different depending on the type of property, doesn't it? So
Yeah.
let's break down those main categories the source talking about.
Absolutely. The main buckets are fairly straightforward. You've got
Hmm.
residential, single-family homes, condos, multifamily buildings, student housing. That's often the most accessible entry point.
Yeah.
Then commercial. A broader category: office buildings, retail like shops and malls, industrial warehouses, hotels. These can offer higher returns, potentially.
But more sensitive.
More sensitive to the economy,
Yeah.
definitely, and they usually need much more active management.
Right.
And finally, land, just raw land.
Yeah.
Bought maybe for future development or just hoping it appreciates over the long term. Very different risk profile there.
Okay. Now, you hear it all the time. The real estate market is cyclical. It's almost a cliche.
It is.
But what does that actually mean for you, the investor, when you're trying to decide, do I buy now? Do I sell? Do I just hold on?
It's cliche because it's so fundamental. Understanding these phases is critical. The source breaks it down into 4 distinct stages. First, recovery.
The bottom.
Pretty much the bottom. Low occupancy, weak demand, not much new building happening. Rents are flat, maybe even falling. Now, the tricky part here is that the real opportunities are rarely obvious then. Smart investors are quietly buying distressed assets while everyone else is still worried.
So the aha moment isn't when the news announces it.
Exactly. It's when you see those subtle shifts, maybe vacancy rates stop falling or landlords aren't giving away free rent anymore. Then comes expansion.
Things are looking up.
Right. Demand, jobs are growing, rents are rising, new construction starts.
Yeah.
But supply hasn't caught up yet. This is when most people feel good about buying.
But maybe getting a bit pricey.
Could be. And the savvy investor's already thinking about the next phase, hypersupply.
Too much building.
Exactly. New construction outpaces demand. Oversupply. Vacancy rates creep up, rent growth slows down, maybe even turns negative. Landlords start offering concessions again.
Like first month free, that kind of thing.
Precisely. Often driven by that herd mentality, everyone building at once. And finally, recession. Supply outweighs demand, high vacancies, rents falling, or barely keeping up with inflation. Operators are, frankly, getting desperate.
Offering bigger discounts.
Big time. Rent reductions, more concessions. This is often when less experienced folks panic and sell, which, again, creates opportunities for those who understand the cycle and have capital ready.
So it's definitely not one size fits all. The length of each phase varies, and crucially, cycles are different depending on the city, the neighborhood, even the property type, right?
Absolutely key. What's happening in, say, downtown office space could be totally different from suburban single-family homes in the same metro area. You have to be specific.
Okay, let's shift gears to the numbers. You found a potential property. It looks interesting. How do you actually figure out if it's profitable, if the risk makes sense? What are those key financial metrics you have to know?
Yeah, this is non-negotiable. Thorough financial analysis. It starts with calculating your potential gross revenue.
All the rent coming in.
All the potential rent, yes.
Yes.
Then, meticulously identifying all your operating expenses, taxes, insurance, maintenance, management fees, utilities, and critically, budgeting for vacancy. Never assume 100% occupancy.
That's a common mistake, isn't it?
A very common one.
Yeah.
Once you have those expenses, you subtract them from the gross revenue to get your net operating income, or NOI.
Okay, NOI. And that's the property's income before you pay the mortgage or income taxes, right? Just the operation itself.
Exactly. It's the pure operational profit. The formula is simple. NOI, gross revenue, total operating expenses.
Got it.
From NOI, we get a really important metric, especially for commercial properties. The capitalization rate, or cap rate.
The cap rate. Heard that one a lot.
Yep. It measures the expected annual yield relative to the property's price.
Yeah.
So the formula is cap rate, NOI property value.
Okay, so a higher cap rate means a higher potential return for the price.
Generally, yes. It signals higher income potential relative to the price. But, and this is crucial, you have to understand why the cap rate is high.
Right. Is it high because it's risky?
Exactly. Is the property distressed? Is it in a declining area? Is there a major tenant about to leave? A 10% cap rate in a shaky market is very different from an 8% cap rate on a stable, fully leased building in a prime location. Context is everything.
That makes sense. Risk and reward. What else?
Then you look at cash flow. This is your net income after you've paid everything, including the mortgage.
So money actually in your pocket each month.
Hopefully. Positive cash flow means you're profitable month to month. And closely related is cash-on-cash return. That measures your annual cash profit against only the actual cash you initially invested. It shows how hard your own money is working.
Ah, okay. So not including the borrowed money.
Right. Just your down payment, closing costs, initial repairs, etc. And for more complex deals, especially longer-term ones,
Yeah.
you really need to look at things like internal rate of return, IRR, and net present value, NPV. These are more sophisticated. They account for the time value of money, the idea that $1 today is worth more than $1 tomorrow.
Right, because you could invest it elsewhere.
Precisely. IRR and NPV give you a much truer picture of profitability over the entire life of the investment, especially when comparing projects with different cash flow patterns. They become essential beyond just a simple cap rate check.
Okay, so you've got the formulas, you can run the numbers, but the numbers alone don't paint the whole picture, do they?
Yeah,
How do you know what to invest in and maybe more importantly, where? This is where market analysis comes in, right?
absolutely. A solid market analysis is the bedrock. It tells you about current values and helps you spot real opportunities. And it always starts with defining your specific market.
Not just the U.S. market or California.
No. What geographic area, what specific property type, Class A office,
Yeah.
affordable multifamily, and who are your target tenants or buyers? Get granular.
Okay, once you defined that.
Then you dive into the market's pulse. What are the price trends? What are rents doing? What are the future prospects? Is the area growing or declining? And what's actually available right now? What's the inventory like?
Makes sense. Then you look at who might rent or buy it.
Exactly. That's demand analysis. Who are your potential customers? How many are there? What are their characteristics? Age, income. What do they want in a property? Amenities, size. Demographic trends are key here. Population growth, job growth.
And the flip side, what's already there.
Right. Supply analysis. Who are your competitors? What are they offering? What's their market share? Crucially, what's in the new construction pipeline? Are there lots of cranes going up? That could signal future oversupply.
Okay.
And you need to look at vacancy rates, how much is sitting empty. And absorption rates, how quickly is new supply getting leased or sold?
So demand, supply.
Yeah.
What else? The bigger picture.
Definitely. Don't forget the environmental and legal study. This means looking at broad economic indicators, interest rates, GDP growth, but also the local job market strength. There's a big employer moving in or out. And then hyperlocal stuff. Neighborhood analysis, crime rates, school quality, public transit access, and critically, local building regulations, zoning laws. These can completely derail a project if you don't understand them.
Wow, okay. That's a lot to check. And then for the specific property itself.
Finally, yes, you analyze its age, condition, size, any special features, its listing history, how long has it been on the market, why hasn't it sold, and then the absolutely critical step, finding comps.
Comparable properties.
Comparable properties that have recently sold or rented in that exact market. You then adjust their prices for differences when maybe your target property is slightly bigger or needs a new roof to arrive at a realistic estimate of its value.
Okay, that is a thorough process.
Yeah.
Now, with all this data flying around, financials, market trends, comps, how do you systematically compare different potential investments without just getting completely overwhelmed?
That's where a real estate investment scorecard becomes your secret weapon. It's a framework for making objective, data-driven decisions.
Kind of like a checklist, but smarter.
Sort of, but more analytical. The very first step, before you even build the scorecard, is getting crystal clear on your investment objectives and your risk tolerance.
What are you trying to achieve?
Exactly. Are you chasing long-term growth? Do you need passive income right now? Are you looking for a quick appreciation pop? How much risk can you stomach? What's your desired holding period? 5 years, 30 years. If you don't know this, the scorecard won't help you.
Right, makes sense. So step 1, know thyself. Then what?
Then you select your key performance indicators, your KPIs, and your criteria. These will definitely include those financial metrics we talked about, cap rate, cash-on-cash return,
The number.
the numbers. But don't stop there. You need qualitative factors too. Location desirability, how good is the neighborhood really? Property condition, major repairs needed. Market conditions, are you buying at the top or bottom? Ease of management, is it going to be a headache? Tenant profile, who are you renting to? And your exit strategy. How do you plan to sell or refinance later?
Okay, so a mix of hard numbers and softer factors.
Precisely. And here's a key part often missed. Not all criteria are equally important to you. So you assign weights to them.
Ah, okay. So if cash flow is king for you,
Give it a higher weight than, say, appreciation potential, which might be more speculative. This customization is what makes the scorecard truly useful for your goals.
then you need a way to score each factor.
Right. You establish a clear scoring system. Maybe a cap rate over 8% gets 5 points, 6-8% gets 3 points, under 6% gets 1 point, something consistent. You do this for each of your criteria. It gives you that apples-to-apples comparison.
Got it.
Then you gather all your data for each potential property, score it against your weighted criteria, calculate a total score, and compare your opportunities side by side.
And see which one comes out on top based on what matters most to you.
Exactly. And the final step, often overlooked, review and adjust your scorecard periodically. Markets change, your goals might change. Your scorecard needs to evolve too.
That's a really practical tool. Okay, so moving beyond just single properties, how do you build a resilient portfolio? It's not just about buying one good deal, right? It's about maximizing returns overall, managing risk through diversification.
That's exactly it. Portfolio strategy is key, and diversification is a cornerstone across different property types, different geographic locations, maybe even different asset classes within real estate.
So don't put all your eggs in one basket, basically.
The classic advice, yes. And your overall strategy might lean one way or another. You might be growth-oriented, focusing on properties in areas expected to appreciate rapidly, even if cash flow is lower initially.
Or the opposite.
Or income-focused, prioritizing stable, consistent rental income from properties in mature markets, even if appreciation potential is modest.
What about fixing things up?
That's the value-add approach. You buy underperforming properties, maybe they're dated, poorly managed, and you actively improve them through renovations or better management to force the appreciation.
More hands-on.
Definitely. And then there's the opportunistic approach, chasing higher risk, potentially higher reward ventures. Think distressed sales, ground-up development, niche property types. It really depends on your scorecard goals and risk tolerance.
And when selecting specific assets for that portfolio, that old saying still holds true.
Location, location, location. Absolute paramount. For residential, you're thinking proximity to good schools, jobs, transit, neighborhood feel. For commercial, it might be nearness to highways, suppliers, customer base, It depends on the property type.
And you'd be digging into the neighborhood stats again.
Constantly. Demographics, economic growth indicators like job creation, and crucially, historical property value trends. Look back at least 5, maybe 10 years to understand the area's trajectory. Is it consistently growing, flat, or declining?
And the financials for each potential piece of the portfolio.
Front and center. Does it have positive cash flow potential? What's the projected ROI? What's the cap rate look like relative to the risk? Remember, 8–10% might indicate better income, but you need that context. How does leverage impact the deal? And factor in all the costs, closing costs, holding costs, future repairs.
The physical condition too, obviously.
Critical. Foundation, electrical, plumbing, HVAC, roof, get inspections. Construction quality matters for long-term maintenance. And don't forget legal and regulatory stuff. Zoning, building codes, fair housing laws, property tax assessments, they can all impact your bottom line.
And always know why you're buying it and how you'll get out.
Always. Define your purpose: long-term rental, flip, retirement income, and have a clear exit strategy. Sell after 7 years, refinance and hold. Know your plan before you buy.
Okay, so you found the perfect property, run the numbers, built the scorecard, figured out its place in your portfolio strategy. Now, how do you actually pay for it? Raising capital is fundamental, isn't it? And it's not always just going to the bank.
That's right. Traditional bank financing mortgages, construction loans is common, but yet usually requires good credit, stable income, maybe a hefty down payment.
What are the alternatives then?
Well, you have private money lenders. These are individuals or companies that lend money, often faster and with more flexible terms than banks.
But more expensive.
Usually, yes. Higher interest rates to compensate for higher perceived risk. Then there's real estate crowdfunding. Platforms like Fundrise or Realty Mogul connect developers needing capital with lots of smaller investors online.
Interesting, like Kickstarter for buildings.
Kind of, yeah. Democratizes access a bit. Joint ventures and partnerships are also huge, especially for bigger deals. You pool resources, expertise, risk.
We'll touch more on those structures later.
Definitely. You can also invest passively through publicly traded REITs, real estate investment trusts. Like buying a stock, but it invests in a portfolio of properties.
So you get diversification easily.
Exactly. For retirement funds, self-directed IRAs can allow you to invest directly in property. And then there's wholesaling.
Ah, yeah, you mentioned that. How does that work again? Less about capital.
Right. It's more about finding a deal, getting a property under contract at a good price, and then immediately assigning that contract to another buyer for a fee before you actually have to close and come up with the purchase funds yourself. It's about finding deals and connecting buyers, really, leveraging relationships and market knowledge.
So lots of ways to fund a deal. But if you need actual investors, how do you convince them?
You need a rock-solid business plan. Clearly lay out the opportunity, the strategy, the numbers, the risks. Showcase your track record if you have one, past successes. Build credibility. Ensure you're following all the rules. Regulatory compliance with bodies like the SEC or Finara is crucial, especially if you're raising money broadly. Maintain open, honest communication. And offer attractive returns, maybe the preferred return for investors, or a clear profit-sharing structure.
Makes sense. You mentioned partnerships. They seem really common for pooling resources. What are the main ways those are structured, and what key terms should people know before they, shake hands on a deal?
Yeah, partnerships are very common. Probably the most popular structure these days is the limited liability company, or LLC. It offers liability protection for the members and a lot of flexibility in how it's run and taxed.
Okay, LLC. What else?
Then you have a limited partnership, or LP, sometimes called a RELP, Real Estate Limited Partnership, very common for larger commercial deals. You have a general partner, GP, who manages the project, finds the deal, runs the operations.
No, active one.
The active one with unlimited liability, typically. And then limited partners, LPs, who primarily provide capital and have limited liability. Their risk is generally capped at their investment amount.
So the LPs are more passive investors?
Usually, yes.
No.
Joint ventures, JVs, are similar, often structured as LLCs or LPs, but typically formed for a specific project or a limited time. General partnerships exist too, where all partners are active and share liability, but that's riskier for the individuals involved.
Less common for big deals, maybe?
Often, yes.
Yeah.
And S-Corp or C-Corp are less common for direct property ownership, but might be used for larger operating businesses in real estate.
The legal structure is obviously important, but the agreement between the partners is key, right?
Absolutely critical. The partnership agreement is the rule book. It defines everything. Roles and responsibilities, how profits and losses are split, the waterfall, decision-making processes, compensation for the GP.
Like fees?
Exactly. Acquisition fees for finding the deal, asset management fees for ongoing oversight, and performance-based fees, often called promotes or carried interest.
Right.
Like maybe the GP gets 20% of the profits after the LPs have received their initial investment back, plus a certain preferred return.
The preferred return. So LPs get paid first.
Typically, yes.
Yeah.
They get their initial capital back, plus a pre-agreed rate of return, say 8% per year, before the GP starts sharing in the profits. That aligns incentives.
And then the remaining profit is split how?
That's the equity split, also defined in the agreement. Could be 80-20, 70-30 LPGP, whatever is negotiated, after that preferred return hurdle is met. Clear definitions for capital calls, distributions, and exit strategies are also vital.
So getting that agreement right is paramount.
Paramount. Along with good liability protection, clear communication, and honestly making sure you're compatible with your partners on a personal level too. Deals can get stressful.
Very true. Okay, let's shift to the future. Technology is changing everything, and real estate is no exception. This whole prop tech space. What are the really exciting innovations changing how we buy, sell, manage properties?
It's moving incredibly fast. AI and machine learning are huge. They're being used for predictive analytics, forecasting market trends, predicting property values with surprising accuracy.
Better than just looking at comps.
Potentially, yes.
Hmm.
More data points, faster analysis. AI is also automating parts of property management, and chatbots are handling basic tenant inquiries 247.
What about actually seeing properties?
That's where virtual reality,
Yeah.
VR, and augmented reality, AR, come in. They're creating these incredibly immersive property tours. You can walk through a house remotely, get a real feel for the space.
From anywhere in the world.
Exactly.
Yeah.
And data suggests these virtual tours can help properties sell faster and sometimes for higher prices because buyers feel more connected.
Wow. What about the transaction itself?
Blockchain technology is making inroads there, creating secure, transparent digital records of ownership and transactions, and enabling smart contracts that could automate things like lease payments or even parts of the property transfer process.
And you mentioned tokenization?
Right. That's using blockchain to divide ownership of a property into digital tokens. So instead of needing millions to buy an office building, you could buy, say, $100 worth of tokens representing a tiny fraction of ownership. It really democratizes access.
That's fascinating. What else is making buildings smarter?
The Internet of Things, IoT. Sensors and connected devices managing energy use, optimizing heating and cooling, enhancing security, monitoring maintenance needs, creating truly smart, efficient buildings.
And all that generates data?
Tons of data, which ties into big data analytics, giving owners and investors unprecedented insights into market trends, tenant behavior, building performance. We're also seeing drones used routinely now for aerial photography, site inspections, construction progress monitoring.
Much cheaper and faster than before.
Absolutely. And looking even further out, digital twins creating detailed virtual replicas of physical buildings to test changes, plan maintenance, simulate scenarios.
Wow.
Plus, there's growing demand for green building technology, sustainable materials, energy efficiency, and integrating ESG, environmental, social governance factors into investment decisions, is becoming mainstream. PropTech platforms are just making everything browsing, transacting, managing faster, and more data-driven.
It really sounds like a different world than even 10 years ago. Okay, so we've covered the foundations, the numbers, strategies, tech. Let's bring it all together. What does this mean for the real estate market looking ahead to, say, 2025? What trends should investors be watching most closely?
Well, the consensus seems to be pointing towards moderate home price growth. Still rising, most likely, but probably at a slower, more sustainable pace than the frenzy we saw recently.
Okay, some normalization. What about borrowing costs?
Mortgage rates are generally expected to moderate, maybe drift downwards a bit, as central banks potentially ease up on interest rates. That should help with affordability, which has been a major challenge.
And will there be more to buy? Inventory has been tight.
That's another positive sign. We're expecting increased housing inventory, both from existing homes hitting the market and, importantly, from new home construction finally catching up a bit, which should help address some of those persistent shortages.
What about who's buying and where they want to live?
Huge shifts there. Demographics are key. Millennials are now the largest group of home buyers, and their preferences matter. Plus, remote work isn't going away entirely. It continues to reshape demand.
Pushing people towards suburbs or rural areas.
To some extent, yes, driving demand for more space, home offices, and it's forcing a rethink of commercial spaces too, more flexibility needed.
How are rental markets looking?
They seem to be rebalancing. Rent growth has slowed considerably from its peak, though affordability is still a major issue in many cities. We're also seeing a subtle but noticeable shift away from areas facing high risks from climate change or extreme weather.
Which could mean
Could mean lower demand or higher insurance costs in those areas, but maybe opportunities elsewhere, or for investors willing to take on that specific risk, perhaps with mitigation strategies.
interesting. Any specific types of markets gaining traction?
There's definitely increased interest in second-tier markets. Smaller cities, sometimes previously overlooked, that offer a good quality of life, maybe strong healthcare or education, and are often undersupplied with housing.
Finding hidden gems?
Kind of. There's also growing momentum behind social impact investing in real estate, things like developing affordable housing or workforce housing, where you're aiming for both financial return and positive community impact.
And technology's role.
Will only continue to grow. AI-powered analytics, VR tours, blockchain for transactions, IoT in buildings, these will become increasingly standard. And sustainability is huge. Demand for green, eco-friendly properties is definitely on the rise for both tenants and investors.
What about other trends? Travel, financing.
We expect a continued global tourism recovery, which should boost prospects for properties and vacation destinations. On the financing side, private credit and debt funds are becoming much more prominent players, offering alternative capital solutions outside traditional banks.
So investors are getting pickier.
Definitely more selective. There seems to be a focus on living assets, residential in its various forms, student housing, senior living, and also industrial properties, especially logistics and data centers, driven by e-commerce and cloud computing.
Any signs of trouble brewing, like 2008?
Nothing on that scale seems likely. However, there are growing levels of distress in certain sectors, maybe older office buildings struggling with remote work, or some retail segments. This could create acquisition opportunities for well-capitalized, patient investors who can navigate complexity.
Wow, okay. That was a truly comprehensive deep dive. We went from the unique advantages of real estate through market cycles, the crucial financial metrics, market analysis, building that investment scorecard. We really covered a lot of ground.
We definitely did. We also looked at raising capital, untangled partnership models, explored the impact of prop tech, and peered into the trends shaping 2025. Hopefully this gives everyone a much more solid framework for making informed decisions.
Absolutely.
Yeah.
So wrapping this all up, what does this mean for you listening right now? As you think about everything we've discussed, maybe consider this. In this dynamic real estate landscape, with technology advancing so fast, demographics shifting, work patterns evolving, how might these powerful forces converge to create unexpected investment opportunities or maybe some hidden risks right there in your own specific local market? Something to chew on.
Definitely food for thought.
Thank you so much for joining us on this deep dive. We really hope this knowledge empowers you to approach real estate investment with, well, greater confidence and strategic clarity. Until next time, keep digging for those insights.